back with video 2 on the PowerPoints. We have been talking about standard costing, which means we've developed a standard for everything. The price we pay for our direct materials, the price we pay for our labor, the price we pay for overhead, the amounts of each that we use. So we have these standards, but obviously in manufacturing it's not going to be perfect. Our example is we're making strawberry yogurt, so you can imagine that sometimes we have to use more strawberries than other times, or sometimes our labor just isn't quite as on the ball, so we have to spend a few more hours making stuff, something like that, or a machine breaks down and we have to stop and fix it, so that was more labor hours, something like that. So anyway, we get off, we call that a variance. It's not a big deal. And we've learned that you can have a total budget variance. You say, well, what's the difference between what we spent and what we budgeted? And that's called your total budget variance. Well, it's not super informative. So we want to find ways to find these differences that are informative to us and tell us where we got off. Was it in our labor efficiency? Was it in our cost of our direct materials? Where did we get off? So let's start looking at these different variances. So direct materials, let's suppose you spent more for direct materials than you thought you did. They can be wrong and off. There can be a variance in two different ways. Either your rate was wrong or your efficiency was off. So in other words, your standard for direct materials, so in strawberry yogurt, we use 8 ounces of strawberries, right? Well, maybe the batch we used had a few bad strawberries, so we threw them out and we got some more strawberries, so we wound up using more than 8 ounces per quart, right? So we weren't very efficient with our usage of our materials or price. Maybe we had to pay a little more, maybe it's not strawberry season, so the price went up a little bit. So how do we figure that out? How do we figure out, well, was the reason we paid more or less, I guess, you could have had better strawberries and used fewer of them, something like that, or paid less for them. So was the reason for the variance price, or was it efficiency, right? So you can figure these out, and you'll figure out if they're unfavorable or favorable. And I just always remember an unfavorable variance decreases profits, right? So whenever actual prices are greater, that's unfavorable. When actual prices or uses are less, that's favorable. But I always think of it in terms of, is it income increasing or income decreasing? Because that helps me remember which way the journal entries go, right? Income increasing works like revenues. The variance goes on the right. Income decreasing works like expenses. The journal entry then is a debit. Okay. So how do you calculate these? Well, the direct materials price variance is the difference between what you paid and what you wanted to pay, right? So to calculate this, you take your actual price times your actual quantity minus standard price times actual quantity. So if you look, you'll see what we're kind of doing is taking quantity out of the picture so we can tell how much of the difference was due to price and not the usage of the materials. All right, the direct material price variance and usage. So all this does is, all we did was combine those two, right? AP minus SP times AQ. That's just a little algebra there. So here's your formula, AP minus SP times AQ. And you calculate the number. And if that number is bigger than the standard, it's a U. If the number is littler, it's an F. All right. The usage variance. So in usage variance, we're seeing, did we use the quantity we were supposed to use? So again, with the strawberries, it's easy to imagine we have a quantity standard of 8 ounces, and so we may have called over the amount That's the equivalent of 8 ounces from the direct materials. We may have called over more. We may have started making our yogurt and said, oh my gosh, some of these strawberries are bad, or they don't look pretty or whatever. And we gonna get some more. Go get some more out of direct materials, and we'll use a few more of these better ones. Something like that. So you can have a usage variance, right? The quantity of materials is different from the standards. That's called a usage variance. And standard price times actual quantity minus standard price times standard quantity gives us our usage variance. And if you look, see how we're stripping quantity out of that? See how we're stripping price out of that? We standard price on both sides. So that's going to tell us how much of the difference is based on quantity. All right, and of course, just distribute that SP across both of them, and you can rewrite it as AQ minus SQ times SP. And if that variance is greater, it's unfavorable, right? Because we used more, right? Than the standard. If the quantity is less than the standard, it's favorable. We use less than the standard, so that's good. Right? If you use less, that increases the income. All right. When do you do this? Well, you can wait until you post the transactions. So you'll recognize that variance either when you move them into production or when they're purchased. Obviously you don't know until you use them, but you can put them into production. All right. The timing of the direct materials usage variance should be computed when they're issued. Many companies use special forms for when we get excess, right? Because obviously if you're doing materials usage, you've called for more, so you can figure that out at the time you do it. So here's a standard bill of materials. If you're going to make 30,000 quarts, you required these certain amounts, right? Here's the standard to make 30,000. You multiply it, and so that's what you've requested from direct materials warehouse, right? And you may have to request more, as it says here. You have your standard, and then you have excess usage forms or return material forms, and you can track your variance as they're issued. All right, so let's stop here, and we'll talk about various analysis.